Hello and welcome to yet another Equity for Keeps video. In this video we're going to cover an opinion written by Jeff Reeves as it concerns Tesla. It says that Tesla stock could see new peaks thanks to these three catalysts. And I think they're broadly production, sales in China, and then inclusion in the S&P 500 index. He began by saying it's hard to take Elon Musk seriously sometimes. Okay, we're not going to read that. But however you feel about Musk and his spaced out aspirations, it's hard to not be inspired by what he has done at Tesla and the value he's delivered for shareholders. The stock is a top performer in the Nasdaq 100 index so far this year with a gain of more than 95%. And while the S&P 500 index is up partly 6% in the last 24 months, these shares are up more than 170% in the same period. There are certainly concerns about Tesla running up too much too soon. Even Musk himself tweeted that Tesla stock is too high in his opinion. After all, but there remain three significant catalysts that should they materialize, they could keep Tesla running into new highs in 2020, and U.S. production keeps ramping up. Musk is pushing to resume production at Tesla's Fremont, California facility after the plant was closed on March 23rd because of the coronavirus pandemic. Interestingly enough, the manufacturing center stayed open longer than some of the other manufacturers, as Musk contended Tesla was an essential business and they didn't have to abide by shelter-in-place orders. Production, not demand, has long been a focus for investors. Tesla produced 103,000 vehicles in the first quarter and delivered for 88,400 vehicles, its best ever quarter performance. The figure includes the last week of March when California operations were curtailed. Furthermore, Tesla noted that the tally should be viewed as slightly conservative, as they only count cars as delivered if it is transferred to the customer and all paperwork is correct. It's worth noting the Tesla's disruption of the traditional auto dealer model has made it well prepared for the current market. The company is currently offering touchless drop delivery, where people can submit payments and documents digitally and then receive their new car without any human interaction. Is the domestic ramp up of Tesla's production a sure thing? Not by any stretch. Some analysts remain convinced the firm's 2020 manufacturing volume will likely be in the low 400,000s and not quite up to the ambitious 500,000 target previously reported by Musk and Co. However, that strong first quarter performance and the looming end of a manufacturing shutdown should give investors hope. Okay, market share in China is increasing, and okay, let's just read that first part. Just as the pandemic affected domestic operations, there were initial concerns that coronavirus related production shutdowns in China could dampen Tesla's substantial growth potential in the country's emerging EV marketplace. However, there seem to be signs that early 2020 hiccups didn't cause serious challenges. Case in point, a Chinese industry group reported Tesla sold 10,160 vehicles in China in March, its highest ever monthly total. There are also reports that current capacity is 3,000 vehicles a week, which could help put that all-important 500,000 overall production target within reach. What's more is that it's increasingly clear Tesla is achieving the success in an auto marketplace that is objectively terrible thanks to public health concerns and related supply chain disruptions. Overall, passenger car sales in China plummeted nearly 41% in March compared with the prior year, but Tesla accounted for nearly one-third of all EVs sold in that period. This confluence of surging Tesla demand and amid struggling competition makes for quite a catalyst, and even held by Tesla time if it misses ambitious targets. Put it side by side with cash-strapped Ford and GM. Okay, we're not going to read that. And call up to 500 S&P 500. Analysts love to geek out on production capacity, profitability, and other data points about Tesla. But there's a much more fundamental catalyst looming for Tesla via inclusion in the vaunted S&P 500, a move that could unlock institutional buying pressure in a tremendous way. So in inclusion, you have to have US headquarters. Filing annual 10Ks involves a market capitalization of 8.2 billion and minimum volume of 250,000 shares per month. Items Tesla has checked off long ago. The item has long been the most practical stumbling block. However, its profitability. S&P demands that the stock must post 4 consecutive quarters of positive GAAP earnings. But while Tesla has managed to operate in the black sporadically since its IPO, including its first ever profit booked way back in 2013, there hadn't really been much of a streak to speak of until recently. Tesla returned to profitability in the third quarter report back in October and followed that up with a profitable fourth quarter, and most recently a profitable first quarter at the end of April. Once again, there are no guarantees that the streak will continue in the second quarter or that Tesla's numbers pass muster under GAAP principles if it does. After all, there have been reports that Tesla is selling parts to SpaceX, making creative use of energy credits and engaging in other numerical calisthenics. So they concluded by saying still, many American stockholders don't actually buy individual stocks. They simply buy passive investment vehicles like ETFs benchmarked to the S&P. The potential of all these hands-off investors collectively adding Tesla to their portfolio at the same time is the catalyst that can be ignored. Okay, so we have pulled up their chart here, and we can see when was this very vaunting peak. That was in February, and since that time it has tested a low of 361. That was in March, and that was that a month thereafter? Yes, almost exactly 1 month. It went to 367, and that was more than 900. So it lost what would that be? It lost within 1 month. This decline we're looking at here is probably close to 2/3 of its value within 1 month. This was right in the peak of the pandemic, of the lockdown. People in countries were getting that issued out and implemented. So I closed at this price yesterday, 819.42, still shy from the 900 and some fraction. So we can see the MACD represented by the two lines, and the crossover points always indicate that there is a momentum, an upward momentum, and there might be an upward momentum, even though you can see that right here, that is not exactly the case. At this point, we are looking at a decline above there, but only the brave will probably put their money when, well, yes, when they're seeing such a decline, I guess. They will probably, they may probably want to put their money. And let's see what it shows over here. Okay, this is a decline, and we can see that it represents that very well. But if you're looking at this, and if you're looking at this trying to happen, and the stock is the price is declining, well, it wouldn't give you a lot of encouragement to put your money. But obviously, it has recorded it. This price potential upward momentum actually occurred when there was actually a decline in price. So, well, if you missed that, you probably I wouldn't say you missed a lot, but it is quite interesting to spot out, to identify. And let's quickly go here. We can see it has a short percent of 13.74. 13.74%. So can we just have a quick look at the if this is going to open up quick enough at the option numbers. So while we're waiting for that to happen, it's this short interest increased by short percent of float increased by 2%, and so if its market cap is 146% and 13% of it is sold short, that is also the amount of money that is in the sidelines waiting to commit. So we can quickly find that. Times 146.26. So I think it's about yeah, it's about $20 billion, $20.9 billion in the sidelines that could possibly go in. So with all that, and we have okay, not too bad as such, so it's almost put call ratio for 30 days is 0.9, meaning that it's almost balanced for 30 days, but for 1 day it's not that much, but even at that, with that number, because there is a healthy number of open call interests there, that with the combination of the short interest and all the other fascinating things, Elon Musk and all the sentiments and all the bullishness and all the infinitely strong power fan base, you can see that Tesla is not a stock to just ignore. I wouldn't really, in the long term, I don't think I will bet my money against it, in the long term, because it's, people are putting their money where the mouth is. So as it concerns Tesla. Okay, thank you very much for watching this video, and please don't fail to subscribe to our channel. Thank you.